I would like to welcome everyone who attends this session and this panel discussion. Just quickly introducing myself, I'm Jan, I work for 360T, which is also part of Deutsche Börse Group. We run a FX multi-dealer platform, which is like one of the biggest in the world with a roughly trading volume of around 200 to 250 billion per day. And since the last year, we also added crypto, so we enable our institutional clients to add that to their liquidity stack. And I'm very happy to being joined today by guys I know pretty much for like 2, 3, 4, 5 years, which is great and which drive the market forward together. Next to me is David. David is a business development specialist for Bitvavo. I think it's, as of now, one of the biggest retail exchanges for crypto in Europe with a very deep Euro liquidity. Next to him, we have Matthias Hirtschulz. He is a partner for Define, managing partner there. He is, I think, leading the activities there in the blockchain digital asset realm for, I think, 10 years now, right? That's pretty much impressive. I know back in the days when I did my PhD, they were publishing some studies, and I was very interested in this back in the day, so that was very nice. Next to him, we have Hein from Flow Traders. Hein was back in the days trader for derivatives, equities, and so on at Flow Traders. Now he's moving to the product side back in Amsterdam, so he knows exactly what's happening in the market and how to trade this. Next to him, we have Alexis, who is, I think, almost 5 years now with Bitpanda. He is a BD expert, very much seated into the financial startup scene and knows the in and out of the retail broker business. And just to be sure, right, I mean, we just heard it, Bitcoin white paper was published in 2008, and it became live in 2009. And almost 5 years after that, you founded Bitpanda back in the days. Not you personally, but your colleagues, which is quite early back in the days, right? And then next to him, we have Andrew from Wyden. Wyden is basically a middleware layer which connects pre-trade, trade, and post-trade. So that being said, just a quick intro for these guys. Very happy to have you guys here on board. And let's dive directly into the discussion. So Matthias, just prior to the session today, we were standing outside and we had a quick chat about target operating models and that you are actually consulting a lot of retail brokers, neo brokers, and banks. And what is your view? Like if they want to kickstart a digital asset business right now, they want to dive into that space, what are the most particular things they have to look at?
Yeah, so I think there are different levels of sophistication, and there's really no one size fits all solution. On the one hand side, maybe I have a small online broker, and on the other hand, I have a multinational bank that might be systemically relevant, and really what's credible and how they should move into digital assets and crypto specifically is widely different. And so the lowest level, let's say, of sophistication you could think of is just doing the reception and transmission of orders, basically technically routing through the crypto orders to a partner and doing the custody with a partner. That would be the lowest level of entry point. But this is really the big disadvantage of this kind of entry point, is that you're not really building your future digital asset infrastructure. You're completely handing over your clients to your partner. And on the other hand, you couldn't expect that this kind of broker is then building the fully fledged solution with connecting various liquidity venues, building their own integrated custody solution, doing the difficult key management. So that's the spectrum, and for many players there's a good intermediate point where they start doing their MiCA license for, let's say, agency trading or the exchange, the execution of orders on behalf of clients, as it is called under MiCA regulation. So you have the clients for trading, but you're working with a partner for the custody part. That's a kind of minimal step, but then maybe we come to that later on. You need to think about how you avoid vendor lock-in and other issues and challenges. Yeah.
Thank you, Matthias. I think that's quite important, right? Because if you just give your client relationship entirely away, I mean, it would be tough to get this back. And I think this is quite a good transition to Alexis. I mean, you've been in this space for like more than 10 years. I think you are one of the biggest, if not the biggest retail broker in crypto in Europe, right? With like 7 million retail clients who are already onboarded on your platform, live and trading, and you have like a very sophisticated setup basically, right? And that's super impressive how you've built this in the last couple of years. Being one of the most successful brokers in that space, I would like to ask you, like, what are the key success drivers from your point of view for building such a successful business?
Okay. Key success drivers. I think the relevant split is to look back and then look forward. If you look back, what Bitpanda got right is retail distribution. That's certainly something we, looking back would not change, right? So we probably did this really well. The second bit is being super compliant early on, working with regulators, not just one, but 3 of them in Europe. We also got that right. The third bit is providing, once you build the infrastructure that is compliant, you realize there's a couple of guys in the market, increasingly so, who want these bits of infrastructure, right? So you look at, and see Gernot Brettenthaler sitting up there, look at some of the Austrian banks using our infrastructure. There's a couple of other guys, N26 as well, does crypto on our stack, right? So they use the stuff that we've built over this time. Going forward, I think this changes a bit. So the market is no longer just about access and reliability. I think it's going to be about product expansion. It's going to be about geographic expansion. And the stack to power this gets increasingly sophisticated and looks nowadays much more like the FX and equity stack of 10 years ago, right? So I see Hein actually nod. I'm going to pause here. Otherwise, I'm just going to keep going.
I think that's pretty much Hein's topic, right? And we see it as well. And we see it with all the brokers that margins go a bit down, right? The market matures. Retail brokers will earn less, and it's just not about add crypto and earn like 250 basis points per trade, right? That might be a good transition towards you, Hein. I mean, you're a market maker also in equities and crypto ETPs and all that kind of stuff. And if we see, or if you take a look, like when shit hits the fan, basically in crypto, right? And that happens more often than it should be. We see like exchanges and brokers like not delivering prices, not answering to requests. So how do you make sure that your clients like are getting good liquidity, tight spreads 24/7, and how do you ensure that?
Yeah, I think the first point is about mindset. Like you mentioned, like we're active in equity, fixed income, digital assets. We do everything on one roof, and especially in the current market where we see more and more traditional players entering the market. So the people we face, the asset managers we facing in the fixed income space, we also face now in the digital asset space. What happens is if we fail in any of the asset classes, it will affect the relationship as a whole. So it's really about the mindset that you need to be there for them, especially we've seen 2008 on the equity side, 2020, and of course we've seen a few crypto winters. It's always making sure you're there for them when they need you most, because then they will knock at your door when it's calm, like they will still rely on you. So I think that's the first part. The second part is like in times of stress, but I think it's also in general, like it's about the plumbing, like what do you do, what's underneath the hood. Crypto is a very fragmented market. There's no like central clearing is lacking, like prime brokerage is like it's the infancy stages. There's a lot of aspects different to the crypto world and in the traditional space, but you need to make sure you do it right and you can anticipate what's happening. And currently what's I think most top of mind is like the 24/7 world that crypto is in, how it's also how the equity space also going into 24/5, even 24/7. And as a traditional player, which we were, it's a complete change of narrative. It's not at 5:35 in Germany, etc. You have the auction, and then you just shut down your systems. You do some updates, everything. It's not how crypto works. You need to make sure the plumbing is in place to do this. And I think that's one of the great things that crypto brought to us, is being able to operate in that way, especially now the equity markets also moving in that direction.
Yeah, thanks, Hein. I mean, David, you run basically a retail exchange at Bitvavo, just getting the mic. And if you look at your retail client base, we just saw the study that you're leading in a sense that your fees are very low, that you have like good execution. What do your retail clients value the most when they onboard with Bitvavo, and how to basically build also an attractive model for retail clients if you want to appeal to that client base?
I think first of all, it's super nice to be here in Frankfurt, right? Me being part of the first DeFi cohort under Philipp Sandner, now being back here in Frankfurt, so that's the circle is closing, so
nice.
that's very nice. And regarding your question for what's important for the retail client, right? Like I think intuitively, I would say it's the pricing, but then I think Bitvavo would be the biggest all over, right? And that's not the case, right? So it's not really only the pricing that's important. I think it's multiple factors, right? It's the onboard, the path of onboarding. It's the first touching points. It's the community building. But I think one of the major topics is simply the trust, and is your system working during volatility? I think that's one of the biggest ones, right? I think you saw it at Robinhood when they basically closed down the sell side for some of the assets, and if your product or if your platform is not running smoothly on high volatility, people lose trust and they switch. So I think it's not only pricing, right, but it's multiple factors.
I would agree in that sense, right? That the overall user experience is basically what's make it a nice product, and not only fees, because I mean sometimes people don't care about fees. We see that with other financial products as well, that sometimes people just press a button, there you go, and just buy a couple of tokens or stocks or whatever. But yeah, it totally makes sense, right, to have like this orchestration going on, that the business is running smoothly. And this is something you do, Andrew, right, with Wyden, where you guys make sure that this fragmented market is like being observed 24/7, that everything fits together from the trading up until the custody piece. So what do you think, like, and how do you help these institutions to get basically a controlled end-to-end workflow? How do you enable that? Because I think it's quite important if you tap into digital assets.
Yeah, I think that's the core question that a lot of institutions are probably also asking themselves as they want to embark on the next digital asset journey, because I think a lot of banks, brokers, and FMIs are building out. There's been the first generation, let's say, versions of this. But I think, yeah, I mean, you mentioned it, Hein, fragmentation in the market, which I guess exists in traditional markets to a certain degree as well. The plumbing obviously has come into the years a little bit in the TradFi space. So I agree with you, Hein. It's sort of allowed for a next generation evolution now, digital assets in the blockchain infrastructure. And so what we're now seeing is that workflow fragmentation is a little bit more the challenge. If you are sort of working without, if you're looking at like the value chain, you know, around execution, custody, settlement, risk, treasury, compliance, I mean, that's a whole end-to-end stack that you need to now rethink a little bit and rewire. And one of the things we're now seeing is that you're basically needing an orchestration layer to connect, in some cases, older legacy systems still, because that's where the general ledger sits. But now you're sort of acting ideally as a translation layer to these new ecosystem components, be it liquidity, be it blockchain-based custody solutions, be it, you know, different types of market data even. Like, you need to really think about when you're going on your next digital asset, let's say, journey from crypto also, once the tipping point is reached potentially with tokenized assets, that you need to understand how you can handle these workflows, right? And so if you sort of look at the different trading models you could probably apply, I agree that the entry model obviously is an agency trading model, makes a lot of sense. And now under MiCA, introducing additional liquidity providers, you know, to give you that best execution ideally, but also a bit more of that transparency towards the end customers, you put it, David. These are sort of the initial building blocks you need to consider. And then the next piece of that is, of course, the post-trade part, which has now become more complex because you've got your, I'd say, crypto, for example, trades like FX, settles either like a security or is handled potentially like a commodity. And it's operating 24/7 on now more API-based real-time rails, right? So it starts to become a challenge as to how you then allocate that, how you monitor, you know, the exposures you might have if you're starting to introduce collateral models, and ultimately that brings you to how do you account for all of this? Yeah? And so that kind of needs to flow together and ideally be automated, which luckily the technology now holds the promise to enable, but I would also say we're not quite there yet. But the starting point or the next point now is that you move from venue-centric models to probably multi-venue orchestration models, right? And that's what we're seeing in the market now. And yeah, happy to talk about it later as well if some of you are interested, but I think that's kind of what we're seeing evolving.
Basically see the same, right? But just one thing to add, because in the traditional world, you usually have like these hours after trading, right? I mean, Hein mentioned it. Xetra stops at a certain point of time, and then you have time to do all the nitty-gritty details, do the reconciliation and so on. And I think, Matthias, you talk to a lot of clients who are also like not afraid of going 24/7, but are like pretty much respecting it, because it's not only tech which has to work, but also like processes and all that kind behind. And in case if there's any problem, right, you should also have like at least some people on call duty. So that makes it a pretty big project if you're like only having a small amount of people trading that actively in your market. Can you explain us, like, because if I would be a bank, I wouldn't be offering my service like 24/5, right? I cannot do that because if Trump or whoever or Elon Musk twitters, markets go up or down, nobody knows. And then I cannot reach, and then I, as a retailer, could not sell. I mean, I don't want to end up, if I would be working in a bank, at the front cover of Handelsblatt or Financial Times, right? Being the only bank who's not 24/7, but only 24/5. So how do you account for that? And what do you see when you talk to banks and retail brokers?
Yeah, so first of all, I completely agree. And crypto is 24/7. And as a bank, that would be, I would say, a reputational risk not to do that. So that's the first point. It's mandatory. The good thing about it is that, as it was mentioned before, that classical capital markets are moving in the same direction. And you basically, when you're going into crypto now, you're preparing for that classical financial markets as well. And you mentioned them. There are three key components. One is the IT side. And we are currently working, for example, with one client. They are implementing crypto trading, and they have a classical front office trading system, and that gets usually shut down after opening hours and their maintenance windows at the weekends. And so the big question there was, how can I operate now 24/7? And I have a lot of products running through this classical front office system. Do I really want to now, with one step, basically move that whole system to 24/7? That would be a major task and also involve, obviously, a lot of risks. So you need to think about how you can handle this, and there are different solutions for this. That's from the IT side. And the second thing to mention here is that a counterparty risk, and also was mentioned, we don't have a clearinghouse here. So we have trading on the weekends. Now it's coming up 4 days of holidays and weekend during Easter, and what you do during this time. And there, basically, you have two components. One of which is the operational side, and the other side is the counterparty risk. How do you manage counterparty risk here? And both things go together. You can think about clever settlement models. So that's, yeah, maybe that's an important connected point to the point of counterparty risk. How does the settlement work? Because there is no fixed connection between the cash leg and the crypto leg. There is no atomic settlement or something like this, as long as you're with a central exchange. And or counterparty. And so you need to think about how can I cleverly do my settlement process. So can maybe my trading counterparty have a Nostro account with me as a bank, and I can do the cash settlement, in real time. How do we work on the custody side to make a even, off-chain real-time settlement? That could be an option. So you can think about different models on the settlement side to mitigate these kind of counterparty risks. And then, yes, as you said, there's the operational side, and you need to think about who is on call, who is doing something also at the weekend, and ensure that if the whole end-to-end process of trading is not working and you cannot place the orders at your liquidity venues, then you run a huge risk, obviously. And that I think are the three components basically you can mitigate the risks, basically the IT infrastructure, the operations, and managing counterparty risk.
I think it makes sense, right? Because tech sometimes is easy to build, but tough to run. At least that's what I learned when I was studying. Hein, we just touched the counterparty risk, and you're trading with a lot of counterparties, basically in different markets, being it equities or commodities, precious metals, crypto. How do you usually trade this, and how do you manage your counterparty risk, right? Because you face it as well, like who goes first? Do you have like these Nostro accounts, which Matthias just mentioned, and how do you facilitate that? Is there something you can give us some insights to? Doing T+1, pre-funding?
Yeah, I can give some sort of high level. I think there's different sort of, there's different flavors on the menu, let's put it like that. And maybe like, I think one point was really interesting about like how banks are entering the space. I think what's really interesting to realize is like how banks are also forced to become active in the space because assets are like taken out and they're moving into the Bitvavos, the Bitpandas of this world, and so that's why I think banks are becoming more and more active. So it's something, it's sort of playing defense and offense. To your point about like how can you settle? It's like in some cases there's pre-funding, but for a market maker, it's important to realize like we have relatively limited capital. I think we have like 800 million or so on our balance sheet. That's what we can use. Of course, in the traditional markets, you have the prime brokers. That's kind of where you get the leverage. In crypto, if it would be atomic settlement, it's very capital intensive. So it's mostly that a counterparty would settle first, and we would settle second. But that means that the risk is not only on the counterparty, it's also on us, because you're relying on the counterparty to settle first, and if the markets are moving a lot, like we've seen in the block fills a few weeks back, like there's a real substantial risk that you're exposed to market movements, and most of the time probably you're more often on the wrong side than on the right side, I would say. So one the flavors in general, it's just that the counterparty would settle first, like to the sell side, so to us, because otherwise the level of pricing we would give if we would have to settle first, the capital that we use, it's for us on the capital market, it's extremely expensive to borrow, and the counterparty already has the dollars. I think that's one. And what's really interesting to see right now is that you see more and more like collateral use cases coming up. I think 2 weeks ago, also in Europe, there was like article how collateral can actually be used and be moved around more flexible. So you see the money market funds that can be used as collateral. You see tri-party sort of setups where like where the Standard Charters of this world, they're also trying to get a foot in the door to like through a tri-party agreement that for both sides that your assets are safe. And if you do this if you think about the clearinghouse, if you do this in a very efficient way, I think these tri-party setups, they will increase, the relevancy will increase. And I would say in a few years, we would go to, it's always post-trade. It's never going to be a settlement directly, but it will always be post-trade. But I could see it move into sort of an atomic settlement where, like as a clearinghouse, everything is just settled simultaneously, and it's not a sequential thing, because I can really see why banks or asset managers are hesitant to do that. But that's currently its market practice just because of the capital that's involved.
Yeah, thank you for this insight. I think it makes total sense, right, to have like a risk management there. And I think, yeah, Andrew, please.
Yeah, I was just going to add, because I fully concur with Hein's sort of view. the market structure that, you know, the TradFi world has set out, we're sort of starting to see that this is going to be, let's say, reused again in digital assets, right? Because again, the counterparty risk issues that you brought up are real. You know, we saw it with things like FTX. I mean, these are all sort of things where all of a sudden people suddenly realize, you shouldn't have everything in one place, and you also need, like, you know, tri-party collateral agents that are really sort of having lien on these assets to, and also what we probably will need to see is some real DVP type of setups, right? But that then of course infers that you have the means of settlement on both sides, ideally on-chain, obviously, if it's in the digital asset world. But then you're kind of like seeing how stable coins, for example, are being treated from a, again, balance sheet perspective. The capital efficiency side also then really suffers. So and then wholesale CBDC, because some of these things happening in a wholesale market, I just don't see how that is necessarily going to fly, because once you bring kind of central bank money on-chain, that poses potentially also huge other risks. So there's still a few nuts to crack in this space, actually. But I think we've also progressed quite well. And as you say, tri-party collateral setups, or even we're seeing traditional assets being cross-asset pledged to also be able to trade crypto, for example. Of course, that needs particular wiring as well. But it's another step forward until we crack all the nuts.
To add just one bit of complexity in referring to a previous discussion with Ralf Aschka, who's the head of digital asset strategy of Deutsche Börse, sitting up there, discussing atomic settlement. And Ralph made the very, very valid point that atomic settlement actually doesn't help as much, because you then lose all the advantages of netting. So you do still need some element of credit line. So I would just say, and quoting Ralph again, it's pretty safe to say it's not going to go full atomic. I doubt that.
Going full atomic, Ralph, right? I mean, it's one of your topics. Yeah, I mean, that's absolute valid point. And I mean, we just touched that, and Hein, you mentioned it, that also like the traditional securities and other assets will most probably go to a certain point on chain, right? Being tokenized in whatever shape or form. What do you think? How will that impact market infrastructure? Because if everything is basically running on the same tech level, will this also impact like how we trade basically tokenized money market funds compared to normal money market funds? Will we basically divide the liquidity, or is there any chance that we basically can add and merge these liquidity pools, right? Because this is one discussion which is always going on. If you have, like, let's say, a normal issued money market fund which sits in the CSD or whatever, and then you have like a tokenized version of it, which was distributed by whatever kind of service provider, and then S&P. You basically have a gap between those two assets. Any views on that?
Yeah, like tokenization is one of the hottest topics which are relevant to us, being active in all spaces. I think there's a few different components. One of them, is it about the plumbing? If you see in the US specifically, like there's these announcements like Nasdaq, they will be tokenizing. They want to tokenize everything basically. And is it just going to be the rails, where everyone probably in this room will agree that blockchain will be more efficient? It will take out some, it could possibly take out some layers because it's just on chain. It's like all the record keeping is done on chain, and it's more efficient. I think that's one piece. The second one is like how these worlds are going to converge, right? Will everything be on chain? Can it be one super app where you trade everything, where of course the Coinbase is the Robin Hoods, that's the direction of travel they see. At the same time, like traditional banks, they're also here to stay. They're employing a lot of people, lobbies are strong, and they can be more flexible. They will be more flexible, I think, than they will anticipate themselves. So I think bottom line, I think tokenization will enable, like it will allow people in unbanked, unbrokered worlds to get access to financial rails. I think that's the biggest sort of unlock on the global level. Like, but like in general, I think it will all be merged in some shape or form. But like crypto is also, like, I think the atomic settlement is probably the most relevant topic out there. I think we're quite far out when these worlds are really converging.
I agree that conversion will take some time, and I think Thomas' book also mentioned it, right? Maybe 10 years. That's a decade, and that. Yes, please. Yeah.
Yeah. So I mean, the question this morning actually was, do you think 50% of equities are tokenized in 10 years? So that means 50%, if that comes true, and there was some doubt, I had the impression, that means that the traditional rails still exist in 10 years. What I think really on a practical level, you know, whether we in 2030, whatever years we have, you know, both worlds converging, I think for decisions today is really not so relevant. What's relevant is that today you will have for the foreseeable future 2 rails to support. And I think the first use cases that will be implemented in the new world are not the efficiency cases, because from a institutional point of view, the costs are actually not decreasing, they are increasing, because I need to maintain 2 infrastructures in parallel. So I need to think about, so the business case on cost reduction doesn't work for many players. That's why I think the first use cases that will fly on-chain is rather new things that are needed. Let's say I have stablecoin liquidity and I need to swap to a money market fund overnight. It's kind of one of the use cases that's heavily discussed. On the other hand, using that space, you know, to access new distribution rates, for example. We have heard this morning as well, Kraken and so on, partnering with traditional financial institutions. I mean, Coinbase has over 100 million users. That's kind of huge distribution power. And so these use cases, I think, are the ones that are first.
I couldn't agree more. Yeah, when you have to, and I mean, we have this discussion going on for such a long time, right? If tokenization can save cost, yeah, most probably it can, but it will not be immediately if you run like 2 systems at the same time, right? I mean, it's very rare that if you add 2 things that it's getting less, right? That's very rare occasions. But you mentioned one very specific point, Matthias, that the convergence of the 2 worlds, we see that with Bitpanda, for instance, starting in the crypto world, now offering equities as well. Bitvavo, basically, what is up next in the retail space? How will you basically expand your portfolio if you are allowed to share some information, right? I don't want to make you a bit nervous. Yeah.
Please close your ears.
It's all chatting rules. Yeah.
Yeah, I think especially at the recent market movements, we've seen that if the volume is going maybe away from crypto, the volumes is low in general, right? Like you as a sole crypto exchange need to be a little bit more flexible and see what else you can offer, right? And I think the general movement, as you mentioned, banks starting to offer more digital assets than crypto exchanges going more into the traditional world. It's going to be very similar with Bitvavo as well, right? So I think there will be some security offerings coming at some point. We need to diversify from this, and then just be very like, yeah, it's always this topic of being a all-in-one app. Is this general market movement is that it's going in this direction, right? That you have the best customer retention, and if you combine this with the transparency aspect, with all of the nice user experiences, I think then you're quite prepared for what's coming next.
So basically, your point is owning the retail user access and then expand from there, right? And deliver on quality and overall
100%, 100%. I think one of the reasons why we also the first crypto sponsor of the German national team was also not only because of a retail perspective, but because of simply having this awareness and giving out the message also to institutional players, right? So, yeah.
So in case somebody needs a ticket for the German national team, they can approach you later on, right?
Reach out, yes.
I think, Andrew, you wanted to add something to the discussion.
Yeah, so I think you mentioned earlier, I don't know if it was you, Hein, Matthias, if you know, the way this is going to tip basically from the traditional kind of plumbing to the new plumbing is that, you know, we need new type of assets, new use cases, so that it justifies the business case basically for banks that don't just look at it from a cost perspective, right? And For example, if you look at the different types of asset classes that have emerged in the traditional financial space but don't really have any market structure around it, so I'm thinking of private markets, for example, you see that there's a lot of private, I mean, probably not the ideal topic to talk about given the way private credit's working or evolving at the moment from a performance perspective, but certainly from a market structure perspective, private market or private equity obviously being one of them, right? And also private credit. These kind of markets are very analog, right? And actually prone to a lot of risk. Obviously, there's a lot of transparency issues around that as well, which are sometimes maybe also by design. But these are the kind of areas that I think as more of these type of assets get tokenized, there will be a need for secondary market liquidity also at some point around these. If those niches can actually help then justify a broader business case. Because if you also think about it, originally when crypto emerged, those that adopted it early, I think they did quite well, right? Because it was a new asset class, you could generate money out of it. And then you're adding all these other ones to it, and all of a sudden you've built out your infrastructure that's actually readying itself for when more the traditional assets actually move onto these chains. So I think as a blueprint or maybe food for thought for some, I think these are the kind of considerations that one needs to have when doing the digital asset roadmap and the broader business case. You need to look at it as a whole and not just individual sleeves, right? Which is not an easy job, but I think is probably the way to look at it. And then of course there's the stablecoin topic combined with the money market topic that you were discussing. I can see corporate treasurers, for example, be parking their money in these money market funds and then wanting to go in and out of stable coins, maybe in less banked areas. Also on the corporate side, being able to mobilize liquidity and payments down the supply chain through these kind of setups. So I think there's probably a few things to ponder there for bigger banking groups that are looking to have a broad digital asset strategy.
I'd love to stretch that discussion out for another half an hour because I don't agree on the fixed income part. But yes, I think it's probably, if you step up a high level, that's probably right. Sorry, I'm just hijacking this for 1 second. I think on the fixed income parts, my background is fixed income and credit and rates. And I think that especially on the credit side, stuff is, the markets are very broad and not very deep. And also you have to read the prospectus, which is often a couple of hundred pages. So that's not that easy. I think PE is similar-ish. Whereas what we see right now is there's a whole generation, especially in retail, when you look at Robinhood, also when you look at us, kids who are quite sophisticated, who use derivatives, but who've seen nothing but perps in their entire lifetime. And if you want to enable perps on a 24/7 basis, you need 24/7 equities. So where do you get 24/7 equities from? Not from the classic markets. You get them from tokenized equities. And that's, I think, the most tangible, immediate thing that we can see as a retail platform, where you can see actual pull in that direction.
It's another tough nut to crack on, right? I mean, how to solve that
Definitely,
one.
yeah.
Maybe we'll solve it in the last 4 minutes. Might be a bit ambitious. Like looking at the clock, right? It's 4 minutes left. I would like everyone to have a quick statement. What do basically institutional players underestimate when going into crypto? And we'll make like a quick round, maybe starting from Andrew, then over to Alexis, and we move the mic simultaneously. Just like 30 seconds. So what, from your point of view, underestimate institutional players when they enter the crypto space?
Yeah, I think it's the operational change and the operating model that they need to adjust to be able to be 24/7 compatible. Also be able to handle like even just key management if they're doing self-custody. The fragmented liquidity market structure, it's just not what they're used to, right? So effectively the first step is a decision, am I going to really engage in this, or am I going to outsource it all, right? These venue-centric models, right? And I think you can learn from both. So there's no wrong way, but at some point it's going to go multi-venue orchestration. So I think that's what I would just promote, I guess.
Thank you.
Yeah, so Andrew's already covered the big one. I would say what they often get wrong or underestimate is how much the clients are actually know about this, right? So you speak to Big Bank X says, yeah, we're going to launch Bitcoin and ETH and XRP, and we're going to make it, a bit of a sideshow so advisors have something to give them. And even the old clients read that in the papers, but the younger ones know their stuff, right? So often they go for it, first wave, realize, oh, this maybe wasn't enough. We need to make this better and have more coins available and not look like this is something we do as a sideshow. And then in the second wave, they usually step up their game and become better.
I wanted to say it's a marathon. It's not a sprint, and I think a lot of the larger players, they expect immediate returns. They think, okay, we enable this, it's going to be magic. It's not how it works, and if you don't think it through properly, you will run into roadblocks later. Also to Alexis' point.
Yeah, I think I can only add to that the complexity is underestimated heavily, and then market players that move into the market today, they see now maybe their peers already have something live, then they ask the question, why do we still need 1 year or 2 years to get the product live? And they might think, I can only, plug in the API for the custodian and I will be really quick. And then you start explaining what's involved in having a really target operating model that survives the test of the regulator, and how do you do compliance, and how do you do key management, and where do you put your backup keys, and what happens then and that. And they heavily underestimate this complexity, and that's what I often see in initial talks when I show them a project plan on what needs to be done and what's involved, end to end.
For me, I think what institutional players are basically underestimating is the seriousness of the space. I think many of the touching points what institutional players have is they hear about some dog coins, some weird names on Telegram and so on. But I think what's actually happening under the hood is very revolutionary, right? It's driven from a very specific kind of viewpoint of how the world should run in the future, right? And I think now it's about, hey, how can both of those worlds converge and give more power back to the people, I would say, and just bring more transparency into the space. So I think that's what's happening.
I agree. I think everyone, or like a lot of these banks, and like this basically like a summary of this discussion, right, underestimate what's happening in the space and how tough this is for banks to get into. And I think we all agree that everyone here is up for discussion afterwards. If everyone wants to talk about crypto, liquidity, provisioning, infrastructure, and whatsoever, please feel to get in touch with us later on. And thank you guys for the good show, for the discussion. Thank the audience. Great to be here. Thank you.